Hey everybody, Marty Missouri here. Second time today, 9/29/2023. This one's your weekly economic update. This one I can keep pretty darn brief. I only have 6 or 7 slides I want to share with you, and I don't see any reason to belabor the explanation of the setup as we see it, but definitely always worth updating you and talking about what our formal weekly study says about economic conditions. And then, of course, as you know, we express that in what we call our PWA index, and it dropped 2.13 points, very much within the range that says recession odds exceed continued expansion odds in the months to come. Of course, it's possible that we're all wrong, and we'll continue to crunch the data and stay very open-minded to that possibility. But while it's there from an investment standpoint and what recessions tend to do to asset prices, caution is warranted right here. The PCE data came out today. That's consumption expenditures, personal income as well, and the all-important inflation data. The first one I have up is consumer spending, and continues to rise, so that's definitely not signs of a recession right here, although the rate of change has dropped a bit here on a month-on-month basis. Pretty much in line with expectations, as is personal income, growing at a 4.8% annual clip, month-on-month 0.4%. As for consumer confidence, as you can see, looks like we're kind of rolling back over, certainly with the Conference Board's reading and University of Michigan's latest reading as well. Consumers are beginning to grow a little bit concerned about the jobs market going forward, still very concerned about the rate of inflation. I think it was the University of Michigan's. The coincident indicator actually wasn't bad. It actually moved up a tick, still not great, but the forward 6-month outlook, it was really rolling over. And I think we've talked about some stats from other sources that say on a 6-month look forward, majority of people do not intend to spend on big ticket items. On the plus side, core durable goods orders in August were indeed better than expected, even though there was a slight downward revision for July. Core shipments, which shows up in GDP, rose 0.7 month on month, which was notably better than the estimate, which was no change. The Chicago Fed National Activity Index is an economic index within our index. It rolled back over into the negative, negative 0.16, 85 data points there. 50 of them currently score negative. Only 35 currently score positive. And then the inflation data. Now, the PCE deflator is what the Fed says they look at the most. Market sure moves on CPI. They do talk about CPI. I think they look at both. The blue line is core PCE, which is the one they're supposed to be focused on because it X's out food and energy. But folks, make no mistake, as I talked about in the earlier video commentary today, ultimately, of course, higher energy prices have to bleed through to that core inflation. Call it 3.9% on the core, still going in the right direction. And again, we've been preaching this from back when inflation was up here at over 7%, that the economy is very likely to slow. Therefore, we will see inflation come off the boil. Now, the Fed says they're not going nowhere in terms of keeping a tight stance until they get back to their 2% target. Talked a lot about that and what we think happens to get there and then shortly thereafter. The headline number, 3.5, so that includes food and energy, and you can see that's beginning to tick back up. And on a month-on-month basis, 0.4% is the headline number. However, core came in at 0.1. And again, core is what they focus on, and the expectation was for 0.2. That sparked a pretty nice rally early in the session. S&P still closed down on the day. The Dow closed down on the day. NASDAQ eked out just a little bit of a gain, but most sectors were red on the day. And then lastly, the Baltic Dry Index continues to shoot higher. Now that scores positive in our index, and this tracks the cost of shipping goods across the world's oceans. That essentially denotes On net, a pickup in global activity. Other things can get in the way of this index as well, supply of ships at any given moment and that sort of thing. And of course, you could flip that on its head and say, listen, it's good, but that's an expense, right? That's a cost. That ultimately is inflation. The way we view this one, though, is not necessarily an inflation indicator as much as it is an indicator of activity in the global economy. But of course, as you can see here, it is the definition of noisy, but we score it for what it is. So folks, again, I told you I'd keep it short. That's just a handful of data points that I'm sharing with you today. Keep in mind things that I tend to do redundantly. The leading economic indicator to coincident indicator ratio is at levels that it's never been before without seeing a recession. Tight credit standards, etc. Recession odds are too high at the moment for comfort. But again, we'll keep an open mind and we'll certainly keep you posted. Thank you as always for watching and listening. Hope you all have a great weekend. Talk to you next week. Bye-bye.